Hello, I'm Jacob Stein, and welcome to this presentation by Alliant LLP on foreign financial accounts, how to set them up, compliance issues, reporting requirements for undisclosed accounts, and tax preparation for foreign financial accounts. So I am a partner with Alliant LLP. Alliant is a global law firm with a large focus on structuring cross-border business transactions. And my own practice focuses on private wealth planning. And given the practice of the firm and my own practice, we have quite a lot of experience in establishing offshore bank accounts, investment accounts, and the like for our US clients. Sometimes that's done in a very simple, direct way, like our client in the United States, let's say, opens a bank account in Zurich. Sometimes it's something much more complex where there are all sorts of structures that are established overseas. And then for these structures, we need bank or financial accounts, or clients use these structures to acquire interests in hedge funds or private equity funds that are overseas. You will find out from this presentation that foreign financial accounts is a fairly broad definition. Pretty much anything other than an actual business or real estate is likely to be included in this definition. So it's not just bank accounts, it's a fairly broad spectrum of things that basically revolve around passive management of liquid investments. So certainly bank accounts, brokerage accounts, investment accounts, and interest in various investment type funds are included in this definition. Despite somewhat popular belief over the past few years, it is not illegal for Americans to establish bank accounts in foreign countries. Far from it. We've had hundreds, literally, of clients over the past several years establish overseas bank accounts. The only thing that's illegal is not disclosing, not reporting these bank accounts to the tax authorities. But you can certainly set them up. You can certainly fund them. It is not frowned upon so long as the accounts are disclosed. So today we will have three speakers for you on this subject. The first one will be Philip Stiebold. I have known Philip now for over 15 years, I believe. Philip, although he is originally an American, has lived in Switzerland for a very large part of his life, and he has been a private banker in Switzerland, I think first in Zurich and then in Geneva, for over 30 years. I've initially met Philip when he was a banker at Saracen, and then he was at Pictet, which is a huge Swiss private bank. And most recently, Philip has been with Sitz Bank in Switzerland. So we have worked with Philip for many, many years. We continue to work with him. He's a very knowledgeable Swiss banker, and his specialty is establishing bank accounts with Swiss banks for American clients. So he will describe to us what is the process of setting up bank accounts in Switzerland for American clients, what sort of due diligence the bank will do, what sort of investment options are available, and what the bank will disclose to the Swiss tax authorities, which then will disclose this information to the American tax authorities. Next, we will have a more substantive presentation, a somewhat longer presentation from a tax attorney, Igor Drobkin. Igor is a partner at Holtz, Slavitt & Drobkin law firm in Beverly Hills in California. Igor is a former IRS senior trial attorney. He's a former special assistant U.S. attorney. He is an adjunct tax law professor. He has lots of credentials. He's a certified tax law specialist. Igor has a lot of experience in helping clients who have undisclosed foreign bank and other financial accounts come clean with the U.S. tax authorities. And as some of you may know, when you fail to comply with the disclosure requirements, the penalties are fairly severe. There are both civil penalties for failure to disclose that run very high. There are also possible criminal penalties. And Igor has lots of experience on helping clients come clean and avoid some of the more severe penalties, right? And take clients through the amnesty program with the U.S. tax authorities. And then our last, but certainly not least presenter is Leslie Sobel. Leslie is a tax accountant, and she is a partner at Lucas Horsfall Murphy and Pindra LLP in Los Angeles. I've known Leslie also, like both of the gentlemen, for many years. She is an exceptional tax accountant, and she does a lot of work in the international arena, both representing foreign clients who are doing business or investing in the United States, and likewise representing U.S. clients with foreign activities, be it passive investments or running businesses. And she's well versed in preparing the right tax forms and figuring clients out to minimize their tax liabilities with respect to their overseas operations. Leslie, in the arena we're discussing today, will have a presentation on what are the tax filing requirements for Americans who have foreign financial accounts, what forms need to be filed, what sort of information need to be disclosed on those forms. I hope you will enjoy this presentation by Alliant LLP on foreign financial accounts, how to set them up, compliance, and tax reporting. Once again, I am Jacob Stein. Enjoy the presentation.
Good morning, good afternoon, everyone. My name is Philip Stiebold. I'm a vice president at Seats Swiss Advisors, which is part of the Seats Banking Group based in Geneva, Switzerland. Also has a branch in Zurich and a branch in Lugano. The group I work with, Seats Swiss Advisors, is SEC registered, which allows us to work with US-based investors who wish to take advantage of having some assets offshore in Switzerland. I'd also like to thank Jacob Stein for inviting me to participate in this webinar. I've known Jacob 18 or 19 years, and we've maintained a good relationship, worked together over those years. It's been really great. So let's take a look at an overview of private banking in Switzerland and what it actually means. Of course, one of the key issues is why would I go to Switzerland? Switzerland has a very long tradition of asset protection and global asset management on a relatively conservative basis, I would say. One thing to keep in mind, I think, that you don't come to Switzerland or go to a Swiss private bank to make a lot of money. What you do is you go to protect what you have and what you've managed to build up over time. But Switzerland is certainly a stable, legal, and social country at a time of political turmoil and economic uncertainty, which seems to be all around us these days. It's quite reassuring to know that you have a safe place to go where the financial system is and the legal system will protect you and your assets. Switzerland has attracted global wealth from all over the world. It's estimated that about perhaps up to 25% of the private wealth in the world is in Switzerland. Of course, these days it's also all declared, by the way. So with that in mind, let's move on to the next subject, taking a look at Switzerland itself. One reason it's stability is, of course, it's a very pleasant place to live, a very stable place, a very prosperous place. The people are hardworking, they're conscientious. It's full of active citizens, as we should say. Switzerland is the purest democracy in the world. In fact, just as a little side note, the real name of Switzerland is the Swiss Confederation. It's a confederation of independent states with a relatively, not weak, but the central government has relatively little power over the individual states based for their own taxing authority, etc. GDP per inhabitant is high. Government debt to GDP is low. Switzerland has a very low unemployment rate, a very high savings rate, and for a small country with very few natural resources outside of its the beauty of the mountains and the rivers, it's the home to some very large, well-known global companies. Nestle is in the food, is a global food company. Everybody knows that. Roche and Novartis are leaders in drug and biotechnology, Swatch in timekeeping, and global banks, the two biggest being, of course, UBS and Credit Suisse. The independent Swiss National Bank, by the way, is a publicly traded entity. You can buy and sell shares in the Swiss National Bank, which has done extremely well. And there's a very high education level of the population and some very top global universities in Switzerland. Now, what is a private bank? This is a term that I think in the US is a little bit less known, though I've seen it written places. But in Switzerland, a private bank is an asset manager that has a banking license. And this allows the asset manager to control the entire process from speaking to the client to placing an order to custodizing the account and managing the account under one umbrella. There are a lot of independent asset managers that aren't private banks, and they will use the banks to do the banking functions, the custodies, et cetera. But the private banks have all that in-house, and that keeps life simple both for the client and for the banker itself. The basic banking services would be, of course, custody of assets, deposits, margin lending, the asset management service itself. The Swiss private banks do not trade their own account, with the exception of from time to time they'll take down a foreign exchange position to make sure they can have proper Forex coverage for the next day. But they don't create their own investment products. It's strictly the basic asset management using the primary tools: stocks, bonds, gold, cash, etc. I would say in a private bank, there's a great deal of safety because all client assets are off balance sheet, except for cash, which means if the bank runs into trouble, the client assets are not affected at all. So another reason to come to a Swiss private bank is diversification. Warren Buffett says constantly on CNBC, diversification works, and he's right, it does. It spreads your risk, it reduces your volatility, and it can increase your returns. And in Switzerland, for a U.S. investor coming here, he gets diversification in many forms. Number one is the investments. He has access to global markets. We buy and sell all over Europe. We buy and sell, depending on the profile, of course, in Asia, in emerging markets, also in the U.S., of course, as well. We also give them good diversification with currency exposure. When we buy and sell Nestle, we buy it and sell in Swiss francs, as opposed to the ADRs in the US. So when we sell Nestle, the client has Swiss francs in his account. And the currencies, of course, become their own asset class in of itself, because people may not realize the Swiss franc has appreciated 400% against the US dollar over the past, since the early 1970s, when Bretton Woods Agreement was finally broken. So that's quite an appreciation, quite a decline for the dollar, and it shows the stability and strength of the Swiss franc. And lastly, with the jurisdiction, when you have custody in Switzerland, to attack those assets through a lawsuit, you have to go through a Swiss court. Now, if you're trying to hide money from your wife, or if you're involved in drug dealing or arms dealing, nothing will protect you. But the U.S. is somewhat of a litigious society, and if someone spills hot coffee on you, it may be a bit more of a problem for them to attack those assets. So it tends to dissuade frivolous lawsuits. Something to keep in mind as well. So what the Swiss bank offers? The private banks offer portfolios. Number one, their primary offering is a managed account that has a discretionary mandate, which means the client and the banker sit down together and we talk about the risk profile. What are the return expectations? What's important to him? Is it growth that he's looking for? Is it more stability? Is it, I don't want to lose one centime, or I like gold, I'd like to be overweight in gold, et cetera. And so based on those profiles, we will construct the portfolio and manage it ourselves, obviously with regular reports going to the client, but the decisions will be taken by us. And the client will receive a monthly report, of course, and whenever he wants to discuss the portfolio, we can do so. Of course, the client is also free to change his mandate if he feels that things are getting more difficult or perhaps more optimistic. Some banks offer an advisory mandate, which is very much like you would see an account at Merrill Lynch in the US, for example, where the client would call and give an order based on his own research, maybe to discuss it with the banker. However, there are relatively few Swiss banks that will accept that because the banks themselves are not registered as broker-dealers. And if the bank accepts a security order from the US, chances are the SEC will come and say, you're accepting orders, you're acting as a broker-dealer, and you're not licensed as one. So the banks that have the advisory mandates, there are two that I can think of, Pictet and Lombard Odier. Pictet tends to do their brokerage through Montreal, and then custody in Switzerland. And Lombard Odier has a New York office now, so they will transact there and then shift the custody over to Switzerland. So it is possible to do. It really depends what the client is looking for. But in general, managed with a discretionary mandate is the flagship approach for most of the private banks. Of course, e-access is offered to all accounts. It's a passive platform, though. It's not transactional. You can't do transfers, and you cannot transact through it. But nonetheless, every day it's updated, and the client can see exactly what his account looks like. Now, compliance, as we all have learned, compliance really rules the roost these days in terms of operations and client activities, etc. When I open an account, I feel very much like I'm a policeman because I need to understand the source of funds, how they were earned, if they were inherited, how did that person earn them, etc. So it's become quite cumbersome. However, it's a process that does finally get done, and it takes, I would say, realistically between 10 days to 2 weeks to open an account, assuming everything is in order. If it's a complex structure, like a trust that owns an offshore company with a U.S. beneficial owner, it may take a little bit longer. But nonetheless, we usually do get through it. Some of the key issues, though, that you have to keep in mind, that the bank has to have an SEC-registered entity to work with the U.S. client. Any Swiss bank that's in the U.S. market now will have that. The bank itself must be FATCA compliant, and any bank that accepts a U.S. client will be FATCA compliant, the Foreign Account Tax Compliance Act, which means they are able to provide the client and report to the IRS the activity of the account during the year on the 1099. Some of the banks are global custodians themselves, and they generate their own 1099. Others are not global custodians, but they will sub-custodize. For example, to Brown Brothers Harriman, BBH is a global custodian that many banks use, and they create a mirror account in New York. Custody remains in Switzerland, but nonetheless, the New York screen will show everything that takes place there, and at the end of the year, they are able to generate a 1099 for the bank, and they'll send it directly to the client, and of course, one to the IRS as well. The one thing that remains the client's responsibility is his own FBAR. The bank will provide, the FBAR, of course, has to state that I have this account in Switzerland, here's the number, and here's the address of the bank. And the highest balance, the highest value during the past year was such and such. The bank provides this to the client directly, and then the client will go online and submit his own FBAR. Well, I wanted to thank you very much for the brief presentation, listening to the brief presentation. All my contact details are here, email and mobile phone. And if you have any questions, I hope to hear from you, and wish you all the best. Thank you very much.
Hello, everyone. My name is Igor Drobkin, and I'm an attorney with Holtz, Slavitt & Drobkin. We are a tax litigation law firm in Beverly Hills, California. We're all former IRS attorneys, and our practice is devoted to representing taxpayers in all kinds of disputes with the IRS and state tax agencies. And one of the biggest issues that we are facing in our practice in the last 8 to 9 years is IRS enforcement of foreign bank account reporting and offshore asset reporting. This remains a very hot issue for the IRS and Department of Justice. And today I would like to walk you through the requirements for FBAR and foreign asset reporting, explain to you what kind of penalties taxpayers who fail to report may face, and then discuss with you the recent news in the offshore tax enforcement activity, as well as discuss the possible solutions to situations where taxpayers fail to report their foreign accounts or foreign assets. So to begin, let's have a quick overview of the U.S. tax system. I always remind my clients that U.S. Income tax system is a worldwide system, and U.S. taxpayers are obligated to report their worldwide income. Please note that when we say they are required to report worldwide income, it doesn't necessarily mean that they have to pay tax on that income. Sometimes taxpayers confuse these two concepts. So even if the tax liability from foreign income is zero, there is still a requirement to report any income earned worldwide on the U.S. income tax returns. The taxpayers are also required to disclose on their Form 1040 any foreign accounts. There is a box on Schedule B that has to be checked, and the country identifying the bank should be listed. There are potential significant penalties for failure to report foreign income, and they can range from accuracy-related penalty, which is 20%, to fraud penalty, which can represent 75% of the tax understatement. In addition to reporting your worldwide income, we are also required to report foreign bank accounts on a specific information return. This return is required under the Bank Secrecy Act, and the form is FinCEN Form 114. Let's call it an FBAR. That's a common phrase that all the practitioners use. So an FBAR must be required if a U.S. person has a financial interest in or signature authority over one or more accounts in a foreign country. So number one requirement is you got to have a financial interest in the bank account or signature authority over that bank account. The second requirement is that as long as the aggregate value of all foreign financial accounts exceeds $10,000, then all the accounts must be listed on an FBAR form. So once again, the requirements are that a U.S. person has to have a financial interest or signature authority in the foreign bank account, and the aggregate value of all the accounts needs to be more than $10,000. I'm not going to go into nuances of what a financial interest is, what is a signature authority, what is a financial account. There are a lot of regulations and discussions about that. For now, and for the purposes of this presentation, we will just focus on this general requirements and discuss what happens if a U.S. person fails to report this foreign bank accounts. So I, again, always remind my clients that there is no crime, there is no violation in having a foreign bank account. The only thing is it has to be reported. So beginning with the 2016 tax year, the filing should be done electronically through the Bank Secrecy Act platform. And the due date for the FBAR filing since 2016 tax year is the same due date that appears on the individual or corporate income tax return. So it's generally April 15th. However, for FBARs, there is an automatic extension that gives you until October 15th to file an FBAR. Even if you don't file an extension for an income tax return, you have an extension to file an FBAR. For individuals who reside abroad, the April 15th deadline is automatically extended until June 15th, or there is an additional 4-month extension available until October 15th. However, there is no automatic extension until December 15th, which usually happens if an individual files an extension, he or she reside abroad, and then they have until December 15th to file their income tax return. So filing due date for the individuals who reside abroad is either June 15th or October 15th. But I think for our purposes, it just helps to remember that there is an automatic extension until October 15th. Please note that in addition to the foreign bank accounts, there is also a requirement to file certain information returns with respect to certain information assets. In this slide, you will see a list of the forms that must be filed. There is a Form 5471, which is required for U.S. persons with respect to interest in certain foreign corporations. There is a Form 5472 when a foreign corporation owns a U.S. company. Form 8938, Statement of Foreign Financial Assets, which is now part of the income tax return. There are also specific forms for U.S. individuals having interest or transactions with foreign trusts, Forms 3520 and 3520A. Now let's talk about what are the consequences of failing to file the form or filing it inaccurately. So with respect to foreign bank account violations, the range of penalties include both criminal and civil penalties. For criminal penalties, a taxpayer may face a fine of $250,000 and 5 years of imprisonment. For civil penalties, there is a two-tier approach. One set of penalties for non-willful failures to file and another one for willful violations. So for non-willful penalties, the penalty can be up to $10,000 for each non-willful violation. For willful FBAR violations, the penalty is the greater of $100,000 or 50% of the balance in the bank account. Please note, and we will discuss it a little bit further, that an FBAR penalty applies to each violation, and each violation is defined as each bank account each year. The statute of limitations for assessment of the civil FBAR penalties is 6 years from the due date of the return. Please note it's not 6 years from the actual filing date is 6 years from the due date of the return. The next slide will give you a summary of civil and criminal penalties as they apply to various violations to file foreign bank account reports. And this slide will give you the summary of the penalties that apply to various international asset reporting forms. 5471 is $10,000 per form, 5472, $25,000 per year. 3520s can be from $10,000 to 35% of the gross reportable amount. So these penalties can be very, very steep. And you will see that Form 8938, which is a part of the income tax return, has a separate penalty of $10,000 per form. Please note that all these penalties can be combined, aggregated together. So if the taxpayer fails to report a foreign entity, foreign bank accounts associated with these entities, there may be multiple penalties for FBAR, for 5471, for 8938. So you got to be very, very careful with all these international reporting obligations. When we are talking about FBAR penalties, one of the most important issues is whether a violation was willful or non-willful. Willfulness for the purposes of the Bank Secrecy Act requires a voluntary violation of a known legal duty. Willfulness is determined based on the totality of facts and circumstances. It includes person's conduct. It includes circumstantial evidence. It includes analysis of whether the taxpayers knew of the FBAR requirements. What did he say to his accountant? Did he ask the right questions? Did he provide correct information? And cases that deal with a willful penalty or non-willful penalty discuss the concept of willful blindness and reckless. So even if the taxpayer says, I did not know about the penalty, the question of willful blindness arises. And willful blindness basically means, did the taxpayer intentionally not ask any questions or did not want to know about foreign bank account reporting requirements? In several cases, and notably Williams and McBride, the courts focused on the taxpayer's signatures on the tax returns, and the fact that Schedule B has a very simple question asking about existence of foreign accounts. And the courts interpret this as sufficient to establish sufficient knowledge on behalf of the taxpayer of the foreign bank account reporting requirements. So basically, if the taxpayer signs a return with the Schedule B in it, it may be sufficient for the government to prove that the taxpayer had knowledge of FBAR filing requirements and thus establish willfulness. Let's talk one more time about the maximum amount of an FBAR willful penalty. I previously said that the maximum penalty can be the greater of $100,000 or 50% of the account balance on the violation date. Subsequently, and relatively recently, there were two cases that determined that the maximum penalty that the IRS can charge here is $100,000. This is based on the regulations that were promulgated by the IRS under the section. So there are two cases which determine that the maximum penalty that can be charged for willful violation is $100,000. There are several cases that took a different approach and said that the statute overrules or overrides the regulations, and the IRS can charge up to 50% of the account value. And the current IRS policy is that in most cases, willful penalties will not exceed 50% of the highest account balance for the years under examination. This is important because previously to that policy that was issued by the IRS, the IRS took position that this 50% penalty can apply to each tax year under examination. So arguably, if the statute of limitation is 6 years, the taxpayer could have faced a 300% penalty for one account. So now, after some litigation, the IRS finally decided that they are not gonna assess more than one time 50% penalty in most of the cases. They give IRS agents some leeway in determining a higher or lower penalty depending on the circumstances. Usually, if there is an egregious fraud, the IRS may go for more than 50%, one 50% penalty, but usually it's going to be just one 50% penalty, which is still a very, very high penalty. Again, for non-willful penalties, the maximum penalty is $10,000 per violation. In this situation, the IRS will determine that the penalty applies to each violation. So note one case, United States versus Boyd, that determined 13 separate non-willful penalties against 13 foreign accounts. Reasonable cause defense applies to FBAR violations the same way as it applies to income tax penalties. And again, reasonable cause is determined under all the facts and circumstances. Usually it involves some good faith effort by the taxpayer to comply. It may involve reliance on the return preparer or faulty advice. So if you represent a taxpayer in an FBAR audit, you must do an analysis of whether there are some factors that can suggest reasonable cause defense. Now let's talk about what is happening in the offshore tax enforcement arena. This remains to be a very, very hot issue to the IRS and Department of Justice. We see an increase in criminal investigations and prosecutions with respect to foreign accounts. There are hundreds of criminal tax investigations that are going on right now with respect to various individuals holding foreign bank accounts. The Department of Justice entered into plea agreements with a number of foreign banks. They are continuing their investigations and indictments of foreign bankers, financial advisors, and all of these agreements, plea agreements, indictments, prosecutions, they generate new information for the IRS to go after certain individuals. And you can see just from 2014 through 2017, there is more than tenfold, there is basically almost a tenfold increase in civil enforcement of the FBAR penalties as well. You may have heard that the IRS and the Department of Justice had a so-called Swiss bank amnesty program. Basically what it meant that Swiss banks could voluntarily enter into an agreement with the Department of Justice to avoid any criminal prosecution. And under this agreement, they were obligated to provide certain information, including the names of the account holders, U.S. account holders, to the Department of Justice. Again, it creates a lot of additional information for the government to pursue. The Panama Papers was all over the news, so now this information is public, again, available to the government. Both the IRS and the Department of Justice use their summons power and subpoena power, including John Doe summonses, just basically issuing summonses to the bank, requesting to provide all the information related to U.S. account holder. Large Business and International Division of the IRS is conducting specific targeted audits with respect to foreign accounts and foreign assets. FATCA that became effective in July of 2014 provides, again, a lot of information for the IRS. There are more than 70,000 foreign financial institutions that share data with the IRS. And we anticipate that all this information will lead to additional audits, additional criminal investigations, and this issue will continue to be a hot issue for the IRS, for the Department of Justice, and for us as practitioners. So now let's talk about what do you do if you have a client who comes to you and says that he didn't file FBARs or he had bank accounts that he didn't report. One of the options that is still available is voluntary disclosure. There was a formal offshore voluntary disclosure program, OVDP, that closed on September 28, 2018. That program provided for a 27.5% penalty that applied to the highest balance of the account, and the taxpayer had to pay tax and negligence penalty for up to 8 past years. Again, this program closed on September 28. However, the IRS recently announced that voluntary disclosure is still available. Individual taxpayers can still come forward and declare their offshore income or offshore assets. This program is available only for legal source income. The taxpayer must obtain a pre-clearance letter from the IRS criminal investigation to determine that they're eligible for it. Basically, it means that the IRS has not yet initiated any audit or criminal investigation and not received any information from third party. The main benefit for this program is to avoid criminal prosecution. While the IRS is not going to give you the immunity, the policy in this program is that it will not make a referral to the Department of Justice for criminal prosecution. Under this voluntary disclosure framework, the taxpayer must disclose the past 6 years and amend all the tax returns or file unfiled returns and report all the income for the past 6 years. The examiners will review these returns and determine all the applicable taxes, interest, and penalties. The penalty framework is that in most cases, the IRS will apply one civil fraud penalty under Section 6663 of the Code to one tax year with the highest tax liability. So they're not going to impose penalty for each year. It will be just 170% tax penalty on tax due for the highest tax year. There will be one willful FBAR penalty that will also apply to the highest balance in the account in the 6-year period. The taxpayers have a right to request a review and imposition of lesser penalties like accuracy related or non-willful penalty, but it's going to be done in rare circumstances, and the taxpayer must present clear and convincing evidence why fraud and willful penalties do not apply. However, all other penalties like 5471, 3520, 8938 penalties will not be imposed. Again, the main benefit of this program is to avoid criminal prosecution. For those taxpayers who may not have criminal risks and whose violations was non-willful, the IRS still provides streamlined filing compliance procedures. Again, it is designated to non-willful U.S. taxpayers who can come into compliance by filing amended income tax returns or delinquent income tax returns for the past 3 years and file FBARs for past 6 years. It applies to both taxpayers who live in the United States and who live abroad. For U.S. taxpayers, they need to amend their tax returns. For taxpayers residing abroad, they either can amend or file delinquent returns. A part of this submission is to file a certification of non-willfulness explaining the facts and circumstances that led to failure to file. And the penalty for those who reside in the United States is 5% of the account balance, highest account balance, one penalty. For those taxpayers who reside abroad, there is no penalty whatsoever. So for those individuals who may have neglected to file their FBARs, but whose violation was non-willful, this is a great program. The maximum penalty is 5%. For those who reside abroad, it's 0. For those taxpayers who do not have any unreported foreign income and no tax due to the IRS provides delinquent FBAR procedures and delinquent international information return procedures. Basically, again, if there is no tax due, you just can file delinquent returns for the past 6 years, just explain your reasonable cause, and there will not be any penalty applied. Are there any alternatives to this voluntary disclosure programs? Sometimes we, as tax practitioners, discuss filing amended or qualified amended returns. Sometimes we talk about the quiet disclosure or payment without any disclosure. These options can be discussed and analyzed. However, all these options have one potential risk. They're discouraged by the IRS. They create by itself a filing that is different from any prior year. All of a sudden, there is an appearance of foreign bank accounts or foreign income. And quiet disclosure does not preclude audits or criminal investigations. So consider it, but consider it with caution. What happens if the IRS examines someone, determines the penalty, and the taxpayer disagrees? Basically, the IRS auditor will determine the penalty after they conduct an examination. Penalty is assessed under Title 31. Note, it's not Title 26 tax, and therefore there is no pre-deficiency judicial review. You cannot go to the tax court on this penalty. But after the examination, the IRS will assess the penalty, and then in order to collect this FBAR penalty, the government must file a complaint in a U.S. district court within 2 years of the assessment. So basically, that's what gives the taxpayer an opportunity to litigate an assessment of the penalty. So if there is a willful penalty, you disagree with it, the government assesses it, and then within 2 years, they must bring a lawsuit to collect on this penalty, and that gives you an opportunity to go before the court and argue that the government is wrong. In this type of cases, the government has the burden of proof, and they need to prove the appropriate penalty by a preponderance of the evidence. So that's pretty much it. That gives you an overview of the FBAR penalties, what is happening in the world of enforcement of foreign bank accounts, and gives you some options about what to do if your client has an undisclosed bank account or an undisclosed foreign asset. Thank you very much for your attention.
Welcome. My name is Leslie Sobel. I'm a tax partner with Lucas Horsfall, a regional CPA firm in Los Angeles. I will spend the next 15 minutes talking about compliance in cross-border foreign direct investing. I will highlight the most important changes to the U.S. taxation of international transactions, most of which became effective on January 1st, 2018. If you've decided to spend 15 minutes with me, then you have a good idea that there is a tax form for every transaction. No doubt that you can find the right form on your software. There's a much more common compliance problem. The practitioner fails to realize they're looking a foreign transaction in the face. First, an often overlooked step is to recognize that a foreign transaction has occurred, that a disclosure requirement exists, or that your foreign client is actually a U.S. person. Some very common errors: asking, and not explaining and then asking. Some of the common errors I've seen recently is thinking that a client will realize that the question, "Do you have a foreign bank account?" includes the French bank account maintained by her rental property manager to collect rents and make small payments. Assuming that disclosing the stock account on your FBAR form was enough, the report of foreign bank accounts, and you missed the foreign issued life insurance contract disclosure entirely. Doing estate planning without inquiring about every person's citizenship and domicile, including contingent beneficiaries and trustees, and thinking you do not have to inquire further because your client only owns 8% of that foreign company. So let's set the stage. The US is one of a minority of countries which base the right to tax on a personal relationship between the person and the country. The US asserts jurisdiction because the taxpayer is connected to the US. Much of the rest of the world asserts tax jurisdiction based on an economic relationship between the person and the country. The rest of the world focuses on how the transaction is connected to their country, not the person. It's only when the US taxes non-US persons that the economic relationship or source of income becomes important. Personal relationship taxation concept is really quite unique in the world and catches many non-US practitioners by surprise. Because the US asserts tax jurisdiction based on a personal relationship between the government and the person, it's important to ask, what is a US person? From there, we can determine what and how income will be taxed. So let's look at what makes up a US person. US citizens, including citizens who are 3 and citizens who are 90. Citizens who have not set foot on US soil in decades. Citizens with no US source income at all. Dual status citizens who are citizens of the United States and a foreign country. The right to carry a passport and the protection by the US government is the embodiment of the personal relationship between the government and the person. So all US citizens are US persons. Second, an entity which is created or formed in any of the 50 states or the District of Columbia is a domestic entity. And in the tax code, it's called a US person, even though it's an entity. Entities include corporations, partnerships, LLCs. The seat of management, which is an important consideration in Europe, really has no bearing in the United States. Corporations organized in US commonwealths, territories, and possessions are generally considered to be foreign corporations. That means Puerto Rico and Guam. Okay, a trust is a US trust if a US person has control over the decisions or if a US court can exercise primary supervision over the trust. Resident aliens are citizens of other countries, and no surprise, they're resident in the United States. They've either met the visa test, which is often called the green card test, or they meet the residency test based on physical presence in the United States. Generally, a resident alien is a citizen of a foreign country who has a visa to work in the United States or is present more than half a year or both. Resident aliens can accrue all the tax-paying privileges and reporting requirements of U.S. citizens. Now, be a little bit aware, because the physical presence test of half a year is not as simple as it sounds. I recommend that as soon as a person has been here in the United States for 100 days, they start counting the physical presence test and making sure they don't fall afoul of it. Once a potential taxpayer has been identified as a U.S. person, they become subject to taxation on all their income from whatever source. In other words, everything, including all income earned in a foreign country. So I want to be really clear here. Even the U.S. person has foreign income which is exempt from taxation. The taxpayer must still file and report the income in order to claim the exemption. It's the same with treaty provisions. If you're not taxable due to a treaty, you really want to consider filing a tax return just to assert that treaty position. In addition, even a U.S. person with no tax liability may be required to file just to report a foreign transaction, or most importantly, to report assets such as foreign bank accounts and stock accounts. Okay, now that we've defined a U.S. person, I'm going to use that to include all the people above unless I specifically say otherwise. So that includes live persons and entities and resident aliens. I'm going to point out when this definition might be different for a particular area. Okay, let's turn our attention to what is income and where you're going to report it. In most cases, a U.S. person is taxed on foreign income as if the income were U.S. source income and reports the income on tax form that they would use for the domestic transaction. Some examples are compensation earned in a foreign country, which retains the character of compensation, capital gains, which are still reported on the capital gains form, and long-term capital gains still get the capital gain rate. And the mortgage interest is deductible regardless of whether the home is in the U.S. or a foreign country. A taxpayer with a rental unit in Uruguay is still going to report the rental unit on the same form as if the rental unit was in Texas. So whichever form it is that the person would file here in the United States, whether it's an individual tax return, a corporate tax return, a partnership return, they're still going to continue to file that. But on top of that, they're going to attach additional forms to this primary return to disclose the foreign assets, the transaction, or the entity. The primary mechanism for avoiding double taxation of income is the tax credit. And this is just one little example, but a U.S. person may claim a credit for foreign income taxes paid or incurred. The credit is limited to that portion of the taxpayer's U.S. tax liability which is attributable to foreign income. The foreign tax credit limit is applied separately to passive and general income, and the Tax Cuts and Jobs Act, which just passed and became effective in 2018 primarily, added two separate limitations, one for GILTI and foreign branch income, two categories we'll discuss a little bit later in this program. As a practical matter, matching the foreign income with the payment of the tax is very difficult because the taxpayer must match the year, the income basket, and the tax paid. So I suggest you manage your expectations of your client and tell the client that there's going to be a little bit of double tax. But fortunately, unused foreign tax credits can be carried forward for use in later years. Okay, so once we've reported the transaction on our primary return, let's say it's your corporate return or a partnership return, then the person is going to report the transaction on additional disclosure forms that are going to be attached to the tax return. And here's some of the major ones. So when is this person taxed on foreign income? Passive and investment type income called subpart F income, such as interest, dividends, rent, was and continues to be taxed when earned, whether it's repatriated or retained in the foreign corporation or the foreign country, and whether it was earned in a flow-through entity or a corporation. Prior to December 31st, 2016, in very general terms, a U.S. person doing business in a foreign country could choose between doing business as a flow-through, where the earnings were taxed immediately, but attractive interest tax attributes such as lower capital gains rates and foreign tax credits were retained, or they could choose to do business as a foreign corporation, where active business earnings were taxed when the earnings were paid back to the United States. When they were paid back, they were generally, and brought back into the US, they were generally taxed as ordinary income at the highest rate with no foreign tax credit. In 2017, this was the year of the 965 transition tax. This was the year when the Tax Reform Act, due to the new Tax Reform Act, the US shareholders were required to pay a transition tax on untaxed foreign earnings of certain specified corporations which had not been repatriated to the United States. So this is a one-time transition from keeping your money overseas in a foreign corporation to what we have now, where the income is, the earnings are going to be taxed in the year of earning primarily. So starting January 1st, 2018, under the Tax Cuts and Jobs Act, a U.S. shareholder of a foreign-controlled corporation will include earnings from active businesses income or as earned in a manner much like Subpart F income, the passive income. Congress called it the global intangible low taxed income, GILTI, but don't be fooled. The GILTI computation is complex, but in the end, it's applied to almost all active income, and it isn't just applies to low taxed income at all. It's basically applies to all your active income in a foreign corporation, pro rata by the U.S. person's ownership of that foreign corporation once it's been identified as a controlled foreign corporation. But so why'd they call it the GILTI tax? I suppose it makes a better C-SPAN soundbite than trying to name the new tax. The now everything foreign is taxable, which I sort of think is would be called the nifty tax. So we're stuck with GILTI, and people are really confused, thinking I don't have intangible income, therefore I don't need to pay attention to GILTI, but you do. GILTI is the tax regime we use today. It applies broadly to active income generated by a controlled foreign corporation. U.S. shareholders are required to include in current income the aggregate amount of certain income generated by this controlled foreign corporation, regardless of whether that is actually repatriated or not. U.S. shareholders who are domestic C corporations are eligible for up to an 80% deemed paid foreign tax credit and a 50% deduction of the current year inclusion, plus a gross up that's a rather complicated formula again, because everything about GILTI is complicated, but C corporations are generally eligible to exclude much of the distribution from that is associated with the GILTI tax. And so they have a provision that some people like to invoke where an individual can be elected to be taxed as a corporation, but it has some pretty far-reaching tax consequences. So before you undertake that, you really need to look into it. So you think, this is not fair. I'm a US citizen and I've lived and worked in Denmark for 20 years, where my Danish corporation provides design services for Danish cheese shops. I shouldn't be taxed. I have nothing to do with the United States. Sadly, the US government can claim the right to tax your foreign corporation's profit. A corporation with no contact with the US at all, simply because you, the shareholder, and your American passport have a personal relationship with the US government. So what they're taxing is the shareholder of that foreign corporation, not the foreign corporation. Okay, we've spent most of our time on foreign corporations and the general overview, but of course there's foreign partnerships, foreign sole proprietorships. In general, a U.S. person is taxed on each of these entities as if they were U.S. entities. In addition, partners in foreign partnerships can offset the earnings with foreign tax credits, U.S. partners. Foreign income not associated with an entity, for example, interest income from a bank in Iceland, is reported just like interest from a bank in Ohio. However, there's an additional information requirements for beneficial owners or signatories on any foreign investment type account. The U.S. government, the IRS, has an excellent guide who must file and report on each of these forms, and it's called the Comparison of Form 8938 and FBAR requirements. And I suggest you find this and read it, and you'll be really surprised by the assets listed which must be disclosed, which include, as I mentioned earlier, the cash value of a foreign issued life insurance contract. Two other things which bear mentioning is Form 1120-F, which is a U.S. income tax return of a foreign corporation, to which the taxpayer will add Form 5472, this time to report a related party transaction of a foreign corporation engaged in a U.S. trade or business. Now, as you would expect, a trade or business would include a branch of a foreign corporation. Everyone would expect that. That's a foreign corporation doing business in the United States. But what you don't expect is that a foreign corporation which owns an interest in a domestic LLC or partnership is considered to be doing business in the United States. Now, owns is the operative word here, because the foreign corporation is engaged in business even if the LLC has a loss. Even if the LLC has no activity, the government wants its 1120-F form filed. An often overlooked reporting requirement is the requirement for foreign-owned U.S. disregarded entities. Very, very common for people to hold foreign individuals to set up an LLC in the United States that they wholly own and then either engage in business or more likely own real estate through this. So there's special reporting for real estate, but that's beyond the topic of this broadcast. So in general, a wholly owned partnership and an LLC are treated as disregarded from the owner. If it was a domestic owner, this type of entity would not have a separate income tax or information reporting requirement because its assets and liabilities would be treated as belonging to its sole owner. But in Final Regulation TD 9796, a domestic disregarded entity that is wholly owned by a foreign person is treated as a domestic corporation separate for its owner for reporting purposes. The result of this is that the disregarded entity will file Form 5472 regardless of whether there was any related party transactions or not. By now, I'm sure it's dawned on you how far-reaching the U.S. government's reach really is. So once a U.S. government can identify the person or entity as a U.S. person, they become subject to taxation on all their income from whatever source. You might be familiar with domestic tax law, where the fine is almost always a percentage of the tax. No tax equals no late filing penalties. So you think the U.S. government agents will be reasonable if you forget to file one of these international forms. Well, they're not. With few exceptions, the forms are required regardless of activity level. The fine for almost every foreign, late, or unfiled foreign form is the greater of $10,000, a percentage of the tax, a percentage of the assets that were not disclosed, or both. So my name is Leslie Sobel. I'm a tax partner here in Pasadena, California, a suburb of Los Angeles, with the regional CPA firm of Lucas Horsfall. And I hope this has helped you and your clients to stay out of trouble today.